All right. Well, let's get started. My name is Sean Stevens with Metroplex Mortgage Services. I'm the president and owner. I founded the company, way back in 2001. So next month will be our 23rd year anniversary. So we're really proud of that. We have a deep specialization in the USDA program, and we're going to be covering that today as well. While I go through the program, I guess if you could let me know, what is your experience level for those of you that are live? If you could just say, have you ever worked with a USDA loan before? What's your just general experiences with the USDA program in itself? I mean, it's a huge program that we see, and it provides huge value. So you take a moment and use the chat board. We'll be using that to communicate with any questions as well. So just a little bit about my background. I entered the mortgage industry way back in 1998. And as I mentioned, started Metroplex Mortgage Services in 2001. We are licensed in Florida, Texas, Tennessee, and Alabama. With our main office in Tampa, we also have branch locations in Sebring, Florida, and Dallas, Texas. We are known heavily for our government loan expertise. With that, we are both a USDA and VA approved lender, which means we handle all that underwriting right within my office, which really provides a high level of efficiency that we're going to be diving into. With the home buyers we work with, everyone's come to know our credit expert. We have high level of a credit expert that we put into each and every program. I'm also a licensed California attorney and attorney for the company. And most of all, I love what I do. And we're going to go through that today in one of these most beautiful programs out there, the USDA loan. So here recently, we just won for the second time the USDA top lender ranking for Florida, which means we've closed the most USDA loans in Florida out of any company that's nationwide. And being a USDA approved lender allows for, as I mentioned at the beginning, in-house underwriting. So we're covering all that right within the walls of our office, so we can just handle the upfront qualification, loan approval, loan funding, closing document. We do everything, all that organizing, arranging. We do that from within our office. All right, so let's go with some basics, okay? Now I'm going to jump back to the chat board real quick. So we got a little mixture of, get a lot of questions from buyers, also have family looking for a USDA loan in North Dakota. Okay, so generally speaking, you might get these questions from buyers. I want to get information on the USDA program. I designed this workshop so you can get the high level points. You can get the 30,000 foot overview. You're not going to be scared of the program. We're going to break it down into bite-sized chunks. So this can be something that can really apply to your market. And you can really you need to be aware of programs, but not be scared of programs. Okay, so now basics on the USDA program. We'll start at the top of the slide. It must be located in an eligible rural area. We're going to dive into each of these bullet points as we go through the workshop. Income's up to 150% of income, so there are income limits. What that means is, based on how many people are in the household, that is going to determine what the maximum income limit can be. So there are limits to how much everyone that's in the house can make to fit within the USDA program. They're 30-year terms, fixed rates, obviously no prepayment penalty. It is a no down payment program, and we base the financing on the appraised value. And we're going to talk about that a little bit later on. So for example, let's say you got a sales price of $300,000, but the appraiser said the value was $305,000. USDA allows you to increase that loan amount in rolling closing costs or possibly eligible home repairs, those type of things. So really, really a high amount of flexibility. As I just mentioned, ability to finance those closing costs when that appraised value is higher than your purchase price. And this is not limited to just first-time home buyers. It's a huge misconception where the USDA program is only limited to those first-time home buyers. As long as they're buying a primary residence, a buyer could sell a home and get qualified for another USDA loan. And we have highly, highly flexible credit guidelines for qualifications. Presently, as we're doing this workshop, our minimum credit score is a 580. Obviously, you have to have minimum credit requirements, not just a score, but highly, highly flexible credit qualifying criteria. Now, USDA property eligibility. Does anyone on the workshop right now, do you have a listing? Are you going to go see a property where I can do a demonstration on how to use the eligibility map? While I'm waiting for that, some generalities of it is the following. You're going to have the darker shaded areas, which are the more highly populated. This area is around our main office in Tampa. You can see all this dark area that I just circled there. Because of the population density, that makes it ineligible for a USDA loan. So remember what I mentioned just a moment ago. If you have to have that home located in an eligible USDA area, all right? So all you would do is, in order to use this map, you simply go to the USDA eligibility site, which I'm going to throw in that in the chat board right now. And this is the USDA area eligibility site. You're going to be entering an address into this search bar. So this search bar right here, you'd enter an address into, and then it's going to pop up the map. Okay, so very, very, very straightforward, very user-friendly, and it's something you need to know when you're looking in eligible rural areas. Now, if you have any addresses, go ahead and throw up there, and we can come back to this a little bit later on. If you have any, and then having that address, I mean, that's a fundamental part of the program, though. We must have that eligible area in order to have a USDA loan to start with. So area eligibility and income eligibility, both fundamental aspects of the USDA program. All right, as we move on, additional property eligibility criteria. This is for primary residences. It can be both new construction or existing, single family residences that could also include townhomes, planned unit developments. We can also utilize something referred to as an accessory dwelling unit or an ADU. That's also commonly referred to as that mother-in-law suite that is on the detached unit on the back of the property, more or less. Condominiums, we can also work with certain condominiums subject to condominium approval. Now, additionally, USDA minimum property requirements, we get a tremendous amount of questions on this. Now, USDA guidelines follow FHA loans, their HUD handbook for minimum property requirements. That is why you will see an FHA appraiser predominantly be the appraiser of choice to go out there and certify that the property meets handbook requirements. And the appraiser will go out there, they will say that it meets the guidelines. They won't say it appears to meet or seems to meet, but it must meet HUD handbook requirements to be acceptable. Additionally, what's also in the handbook is heat source, flooring, plumbing. A common question we get, and this is going back years and years and years, is if a working stove is required to meet a minimum appliance requirement. Remember, there is no minimum appliance requirement, but if they're there, they must be working. I've spoke to appraisers, time and time again, they say they physically go around and check any appliances are there, stovetop, dishwasher, whatever it may be. It's got to be working if it's in the home. All right, any questions so far? As you get questions, anything top of mind, just throw them on the chat board and we'll get to them as we go through the course. One additional item this is updated, going back to December of 2014. So we're almost at the 10-year mark on this, but there's still a lot of misconception, miscommunication, and misinformation from lenders on if USDA will permit an in-ground swimming pool. So there's no restrictions. Everything is just like any other program. In-ground swimming pools are perfectly permissible as long as they're working, just like any other program. In the old handbook, there were restrictions for in-ground swimming pools. So they must be in working condition, but having an in-ground swimming pool on its own there's no restrictions for USDA loan if anyone has heard that. And don't be scared if you get a buyer comes up to you and they say, well, I want a USDA loan, but you've never worked with it before. You just got to have the resources available. That's what we step in and help out. And I have the team in the office where we can just manage the process step by step and help with that qualification and get your questions answered. You do not want to get on a limb and start quoting guidelines that you're not sure of, but more than that, even, you don't want to lose a buyer because you're not sure of a program and you have that uneasy feeling. Because if the home buyer does not think you're confident or comfortable with the program, they will more than likely call somebody else and move down the road. Okay, so the big thing about this is not to memorize these guidelines, but just to gain that overall comfort level with the USDA program. Now, USDA loans do not have any acreage requirements. USDA guidelines simply state the site size must be typical for the area. And what helps to establish that is the appraisal, the other comparable sales that have been done in the appraisal report is what helps establish that that acreage is typical for the area. If you have 20 acres, 15 acres, 12 acres, 18 acres, and those are sales that the appraiser has used, those help establish the market for the site size being typical for the area. Old guidelines had a limitation based on that, but that has been removed. And once again, we're coming up on 10 years from that, but there is still a lot of misinformation out there between realtors and lenders alike. Okay, another one of my favorite topics is private roads. So who in the workshop right now, who has ever dealt with a private road maintenance agreement, dirt roads, any of the above? Because this comes up quite a bit. And this is another confusing point for lenders because they're just not familiar with what the guidelines are. So each loan program has a different nuances for private roads. If it's a truly private road, USDA loans do not require what's called a maintenance agreement. USDA loans do require permanently recorded easements. I have listed there. And then just from a practical standpoint, one key aspect is making sure that it is public or private. Many counties have a separate roads and bridges department, and that is used simply, that you can use that as a great resource to determine if that road is considered some type of public classification or private. Don't just rely on if it's paved, dirt, gravel, or some other type of road surface. But one thing to be aware of is if it is a private road, there's different guidelines for different programs. And we work with FHA loans, VA, conventional loans. So we're fluent with all the programs. USDA loans is really where we separate ourselves because we have that in-depth experience and expertise in how to navigate this program and maximize its benefits. Now, under private water tests, so if you got a private well for drinking water, okay, be prepared. You have to have water test, okay, in advance of closing. So private wells, you'll have water testing done. If it's on public water, no water tests are required. Now, termite reports are not required or termite inspections are not required unless the appraiser states that, the contract states that, or somebody else during the process requires that, maybe triggered by another inspection, but they're not required per guidelines unless so stated by the appraiser or some other document that comes up. Septic tanks. There is no specific septic tank inspection required. The appraiser could indicate that everything meets handbook requirements. That will suffice for this purpose. But you must be aware when there's a septic tank involved, you have to meet minimum distance requirements. And here they are. So between your property line, septic tank, drain field, and there's some local authority guidelines in there as well too. Bottom line, what you want to take away from this is when you have that well for drinking water and a septic on the property, know the distances between those two as well as the property line, or that's something that could come up and bite you as you get down to the point. Usually the surveyor can document that. The appraiser may be able to document that as well too, but they may push it over to the surveyor to complete that analysis. Okay, manufactured homes under USDA. We work heavily with manufactured homes. Now, generally, existing manufactured homes are not eligible. That may be changing as the year goes on. But currently, USDA loans offer what's called a manufactured housing pilot program, which permits existing manufactured homes to be eligible in certain states. Two of those states we're licensed in is Tennessee and Texas. So we're looking at 2006 or newer. They must meet other foundation requirements per FHA guidelines. They can be double wide or single wide manufactured homes and a minimum square footage of 400. Now remember, modular homes are treated as single family homes for financing purposes. So no additional layers of criteria or qualification that we need to follow for modular homes. Manufactured homes and modular, two different categories. We're talking about manufactured homes right now. And also in every state that we're licensed in, we can work with new construction manufactured homes where we approve a dealership beforehand and they deliver the home to the home buyer's lot. And then that upfront closing occurs. That's where commission checks are cut, keys are given, closing happens. And then the home is put on the lot and built over the next usually 2 to 3 months, I would say. And then the buyer moves in thereafter. So that's our upfront single close construction loan that we can work with where the closing occurs upfront prior to construction. Now for some ineligible property types, anything located within an ineligible area. So if it's not within that eligible area map, then it's not going to be an eligible property to begin with. Those multi-unit properties, the duplex, triplex, the fourplex units, where you have that rental capability. I know it's a USDA program. We get a lot of questions on vacant land. So we're not able to finance vacant land or those properties that are primarily used for agricultural farming or some type of commercial enterprise. And then obviously condominiums that do not meet specified requirements won't be eligible. And just like any program, any of these residential programs we work with, they must be predominantly residential in use, character, and appearance. Those are great descriptive words that really help qualify the program. Now, as we move on, this next section, we're going to be talking about repair, how we can finance repairs into a USDA loan after closing. This is great for those big ticket items, roofs, flooring, HVAC units. So we can finance them into the loan up to the appraised value. The repairs cannot exceed 10% of the loan amount or $10,000, whichever is less. And it cannot affect livability of the dwelling. So for example, they have to be able to live in the home while the repair work's being done. The roof updates, the flooring, the HVAC units, those type of repairs allow that. This is not something designed for structural effects, safety of the home, or the sanitariness of the home. So a great tool to have in your back pocket. You're not going to use it all the time, but something that can help keep a transaction going to closing with the repair work being done afterwards, after closing. So basically you go to closing, keys are given, closing documents signed, commission checks cut, and then the repairs would be done after closing, where the money for the repairs is set up into an escrow account with the title company. So especially if you have negotiated with a seller, maybe they just lost a contract because of repair issues, you know what those are going to be. You might have bids already lined up. We can use that to properly market the property for your next buyer. And with the idea of letting the seller know we can take care of these repairs after closing, and they can move on to the next property without dealing with those headaches. So really a great, great feature. And here's some examples of what it would look like when the appraiser does go out there. Here's a snippet from an appraiser. You can see there where they marked it as subject to repairs. So in this particular one, there had to be an AC unit installed. And here was the verbiage they put in further along in the appraisal report. So basically the appraiser is saying our value is, in this example, $150,000 if once the repair work is done. Okay, so we're getting full credit for the repairs, and that's being done after closing. So really, really a convenient feature to help keep our transactions on time and without having to delay closing and get bids, get inspectors out there, get contractors out there, whatever it may be. Here's an example. We get a bid from, in this case, the AC company. And then this shows us being able to, in this case, we had a higher appraised value and we're able to increase our sales price of 141. We're able to increase that and put the HVAC unit repairs into the loan amount because the appraised value in this case came in higher. Now you can also hold this money back from the seller proceeds. Okay, there's a couple ways we can structure that. So any repairs that you may need, we can take a look at this as a solution. Okay, as we continue on, we're going to talk about USDA income qualifications. So right now I'm going to use as an example, Florida, USDA updated their income limits back on July 13th. And here's our current income limits in Florida. For the majority of Florida counties, we're looking at, so if you have a 1 to 4 person household limit, so this is 1 to 4 person, everybody in that household income cannot exceed $110,650. So let's say you have husband, wife, and 2 children. You got a 4-person household. If the husband and wife are both working, we've got to keep all that income within $110,650. That's going to count child support, any Social Security, any self-employment income, any W-2 employment income, base pay, salary, overtime, commissions, you name it. If that jumps up to $146,050, when you go to a 5 to 8 person household. So for example, you have husband, wife, 3 children, maybe grandma and grandpa in the household. I mean, then your total combined income limit is $146,050. And once again, that's for everyone in the household, not just those who were on the loan. So another one of those critical components that we scrub through and get those details done up front to ensure our closing. Now you could have medical expenses, you could have childcare expenses. There can be expenses that get deducted from that. So don't ever assume someone's income may be too high or too low, because we have different calculations we'll do based on the verification of employments, based on the pay stub we receive. Then they might have childcare, after school care they might have. For each child, each dependent, they have $480 deduction. So we have a series of expenses we can deduct from that in case they do go over. So don't assume one way or the other they make too much or not enough money. We'll crunch the numbers and give you that budget for them to work with. And then we also deal with, I'm sure most of you have heard the term debt ratios. So when we talk about debt ratios, we're moving into the situation where we have home buyers who are actually on the loan themselves. So those, not just the household members, but also the people that are on the loan who are qualifying for the mortgage. So for a housing expense, we need to generally keep that at 29% of their total income, but that can expand up to 32% or 33%, depending on their credit and their overall factors. In their total expenses, need to stay at least at 41%, but there could be factors that allow that to expand upwards to 44 or 45%. When I say the word debt ratio, what that means is we're taking total income versus total monthly payments, student loans, credit cards, mortgage payment, and we're calculating those qualifying ratios. When you hear the word debt to income ratio, we're looking at total income versus total payments, and we're taking that percentage. And then we're not looking at balances per se. We're looking at really the payments that result from those balances: car payments, credit cards, collection accounts, repayments, child support obligations, alimony. Those type of monthly recurring payments all get figured into the debt to income ratios. And for self-employed borrowers, common documents you're going to see there are going to be 2 years of tax returns. We'll get a year-to-date profit and loss statement. If they pay themselves a salary, there's going to be W-2s available, K-1 forms, or many of you are probably familiar with Schedule C forms. So these are common self-employment documents that we'll do. And we even offer a courtesy tax return self-employment analysis review, which allows us to dive deep into that income before even having to do a credit review or anything along those lines. So because when you're dealing with self-employed, it is critical to get that income nailed down at the beginning because of the various ways income can be calculated on both personal and business tax returns. Okay, so got a quick question here. What if a buyer just got divorced and then went ahead and just got their first job with no job history? So it all depends on if they were, now Donna, let's say if they were going back to the workforce, maybe they were at home raising a family. There are guidelines that allow for that flexibility. Let's say previously they were working and then they went to raise a family for 5 to 6 years and they're going back to the workforce. That can be permissible. If there's not, there can also be gaps in employment explanation we can look at. Primarily, we're looking at also is how to calculate that stable and dependable income. So there could be flexible with that depending on other factors. So that'd be one we definitely want to review and dive into the details to give you an overall a comprehensive type of answer of what could be done if there has to be a waiting period, if we can move forward right now. So that's a great scenario. Thank you for that. And then there could be potential with that. There is good flexibility in the guidelines depending on all the facts. If you have more details, we can definitely talk offline on that as well. And likewise, if anybody's got further questions after our workshop wraps up, please feel free to reach out. Let me know. We can schedule a call and go through the details. All right, as we jump into credit qualifying, as an approved USDA lender, we use a program that is referred to as the GUS, the Guaranteed Underwriting System. This is specific for USDA lenders. And what the GUS system does is just like you might have heard the term Fannie Mae desktop underwriter, you might have heard the term automated underwriting system. What USDA does is it issues findings. So it'll say an accept, it'll say refer, or it'll say refer with caution. You see here. Those are different levels of acceptance, which requires different documentation for us to submit to USDA as part of the USDA commitment process. Now, that doesn't mean you're approved or denied. It just means we have different checklists we follow. Whereas, let's say I'll give you an example. Let's say if we have an accept, that means we do not have to get any credit explanation letters. Whereas if we have a refer or refer with caution, we're going to have to explain every bit of negative credit that's on the credit report. Likewise, on accept, we do not have to verify rental history. We're on a refer with caution. Majority of the time, we are going to have to verify that if there is a rental history. So the accepts allow for a more streamlined processing, but we work with refer or refer with caution in many cases. Now, if any of you heard the term, you can just say yes or no, manual underwriting or automated underwriting. It'd be great to just get a few. That's more technical terms, but those you might hear that out in the field from time to time. Okay, and here's an example of the GUS underwriting system. Here's a screenshot where you can see the accept right there. And on the next page, let me jump over to refer. And this means it's a more manual review of the process. So they both get to the loan approval stage. We have a manually underwritten loan. That means there's going to be more of those explanation letters, a deeper dive on some of the more restrictive debt to income ratios that we just talked about. And it's something we deal with on a day-to-day basis. So if you ever hear a lender say they don't work with manual underwriting, that's because they don't have the experience to do so. It is a more intensive part of the process, but something we can still, we're still able to close those loans in less than 30 days, whether it's manual or automated. Okay, now we're going to talk about special circumstances for a moment. So, as when I talk about mortgage programs, we're talking about conventional, which is Fannie Mae and Freddie Mac, FHA loans, VA loans for veterans, and obviously the USDA program. So each program is going to have different criteria under these special circumstances. So today we're focused on USDA, and where you have, let's say, collection accounts, you got to be aware of medical versus non-medical. and short sales, bankruptcies, and foreclosures. Before we jump into this, got a quick question here from Shelly. Is there a time frame between current versus past rental histories? No, you don't have to. We have to show a 12-month history if we have to verify it, if it's there. So let's say they rented an apartment complex for 12 months, then they moved in with family for 6 months. Now they're renting in a new place for 6 months. We would verify the 6 months we have, and then the 6 months that they were living rent-free or living with family. Okay, so hopefully that answered. We're just going to get that 2-year address history overall, and then we're going to verify the last 12 months of payment history within that 2-year address history. So hopefully that answered your question, Shelly. If not, let me know and I can expand on that. And then rental history ties in with credit, ties in with these special circumstances. So great timing for that question, because as we look at collection accounts, medical versus other, then you have short sales, bankruptcies, and foreclosures. So medical collections, although they may hurt credit score, they are not going to be held against them from loan approval, loan underwriting guidelines. Whereas collections, let's say for credit cards, car payments, student loans, whatever, finance accounts they have, personal loans, those type of collections there are going to be additional considerations we have to review under that. And likewise, I got this great chart I put together for you, which shows a comparison of the 4 programs side by side. So going from left to right, all right, we got USDA, VA, FHA, conventional. You can see in the first line there, it talks about maximum financing. So USDA and VA are both really well known for their no down payment programs. FHA's got that minimum 3.5% down payment. And then primary homes, you're looking at 3% down for minimum. Second homes or vacation properties, that's a 10% down. And investment properties, usually you're at 20% down. Technically, you can do 15% down if it's a 1-unit investment property. USDA does allow you to increase that loan amount up to the appraised value. You can finance in closing costs with that. VA, FHA, and conventional loans do not permit that same feature. There's also program fees associated with each USDA, VA, FHA. And conventional loan has that mortgage insurance, which can vary how that's calculated depending on how much money you're putting for those less than 20% down payment programs. Under your waiting periods, okay, let's talk about this for a moment. If you are when I say bankruptcy, that means the date of discharge to the present date. So maybe the bankruptcy happened in January 1st of 2000. We met our 3-year waiting period at that point. So USDA has a 3-year waiting period on bankruptcy, foreclosure, and short sales. Those can be reduced depending on credit exception availability, depending on their explanations, depending on the facts, depending on the circumstances which led to the bankruptcy or foreclosure or short sale. Those allow for a reduction in those standard waiting periods. VA, highly flexible with 2 years across the board. And then FHA has their own waiting periods, as well as conventional loans have the most stringent. And down here, we get a tremendous amount of questions right now is what are the maximum you can be paid in seller concessions? So a seller concession is referred to, that's where the seller will pay towards a buyer's closing cost. Not always available for the market. But when it is available, both USDA and FHA allow up to 6% of the sales price to be paid towards buyer closing costs. And also VA has their own criteria, which is very unique. We can actually, I know we're not doing a course on VA today, but VA actually allows a seller to pay off veterans' debt at closing. You could pay off credit cards, a car loan, a collection accounts. Those could be paid off at closing. And conventional loans have, depending on the down payment, if it's a 3% with less than 10% down, 6% of sales price, 10% or greater, and they have a 2% cap for investment properties. So those are your seller concessions. Now I got a question from Roxy. Would a home that needs a tear down built in 1951 and wanting a new one built be eligible? It could be under our renovation program, that could be a possibility, depending on, we'd have to get builder approval on that. And that'd be a good one for us to speak about offline. There's a lot of technicalities with that, but that could be a possible option that we could work with, not under that repair program, but we also work with repair and renovation under the, where we have builder or contractor approval. So that could be a possibility. Yes. Great question. Okay. Now we're ahead of schedule. So anytime, any question scenarios you have, we're going to be able to have time to get through all those today, and then hopefully be able to get you guys out a little bit early. So with processing, closing, and marketing USDA loans. Okay. So USDA loans do not have PMI. So PMI is referred to as private mortgage insurance. Let's go back to that side-by-side comparison. So here is USDA's monthly fee. It's 0.35% of the loan amount. You divide that by 12 months. That's going to be that initial premium. FHA has mortgage insurance premium of 0.55%. Conventional PMI can be monthly. It can be built into the loan. It can be paid in a lump sum. So there's a variety of ways that monthly cost could be paid when conventional PMI occurs. VA has no monthly payments associated with it. VA is a beautiful, beautiful program. So let's go back to, so that's part of the program cost with USDA, but it's not technically PMI. But it is one of the lowest. It is lower than FHA. USDA loans have better borrowing costs than FHA. Plus, you get the ability for no down payment and the features of including closing costs and financing those repairs into that appraised value. And then what is no down payment? These are conversations we have with home buyers every day. Many buyers feel that no down payment means the same as no money out of pocket. And that's just not true. Think of it this way. They're going to have earnest money deposit. They're going to have appraisal fees. They're going to have inspection fees. They're going to have closing costs. Even if they are financing the loan, they're still responsible for them in that manner, unless the seller is paying for those out of what's been negotiated. So when a buyer constantly says, well, I'm getting a no down payment loan, why do I have to give a deposit? And make sure you're always aware deposits are used to secure the contract. It shows their good faith, and it's money that gets credited at time of closing. They could get that money back depending on how much is financed or the seller's paying for, but there's no guarantee they're going to get that money back. So just make sure that you're aware of that when they ask you, am I going to get this money back at closing? Defer to the lender, defer to the loan officer who is handling their financing. So big question we get is a no down payment. Remember, it is not the same as a no money out of pocket loan. Those are just we don't have those programs out there. So no down payment is as close as we can get and provides that high flexibility. So we talked about the seller concessions. I want to break that down again. So we have 6% of the sales price for USDA and FHA. VA has a nice split where they allow a certain amount which can be used towards paying off debt, but there's no limit for actual closing cost. And conventional loans have that breakdown where if it's less than 10%, you're looking at 3% of the sales price. 10% down or greater is 6%, and investment properties are 2% of the sales price. Now we got a couple of questions here where it's myth versus fact. Now, there comes a time each year where USDA goes through an appropriations process where they get money refunded. That happens at the end of their fiscal year, which is September 30th. During this time, we don't stop down. We continue funding as usual. So just because the USDA is getting money reappropriated doesn't mean the program slows down. If your lender does do that, you may need to look for a different lender because they're not in tune with some of the nuances with USDA. And they may not be the actual funding source anyway. They may be outsourcing to another party for that. USDA loans do not allow in-ground pools. We busted that myth earlier today. And USDA does not only do farm loans. You got to remember, under USDA, they have a huge umbrella of programs that they work with. And their single-family housing program, we're an approved lender under the guaranteed loan program. Now, there's a common myth that USDA only offers smaller loan amounts. In fact, USDA has no loan limit. As long as the borrower qualifies, they're within income limits, there's no limit on what they can borrow. It's based on what they qualify for. And we also covered that you are able to finance repairs with a USDA loan. And I'm going to be getting out to everybody who registered and joined today a link to our USDA educational site. I've got video after video on a variety of different options. I do video tips every week, and you're going to be on that list to get those. Just make sure you check your junk or spam mail as those go out. Great resource for you to forward and share with your buyers. And one common question that we get is, how do you refer someone to our team so we can really give them the white glove service and move them to the front of the line? The best way is to get permission for us to reach out to them, and then just call, text, or email with their information. Then we can start to follow up. Or if they won't, you can get permission from them for us to reach out to them directly. And then you can always send us an email as well too with their contact information. Whatever is going to be the easiest, just get us their details and we can start to follow up. We've got the resources on the team to help with that. And here is the timeline we call the homeownership success assembly line. The first step is creating that successful referral, where we go in and you get us their contact information. We start to follow up, and then we keep you in the loop. We've got the team. I've built the team in our offices that's able to assist and reach out and keep the process going. So we move from point A to point B with the whole idea of getting to that closing table as quickly as possible. So creating that successful referral is step one. Getting out there shopping for a home in the right price range. We're seeing a flurry of qualification letters right now that are simply not worth the paper they are written on. So you have to do your due diligence with your lenders, whether they're local, out of state, online, whatever it may be. Do your research, reach out to the loan officer that's handling the file, and make sure they're competent with the program that you're qualifying them for. Many lenders, unfortunately, will offer a no down payment program just to get the buyer in the door, and then they try to flip it to an FHA or conventional loan because that's where their comfort level may be. That's unfair and that's deceptive, and be on the lookout for competency with the loan program, that they know what they're talking about. You can have a general conversation with the loan officer, get a gauge of the file, and understand where they're at without them divulging personal confidential information. Then once we have the sales contract received, then we begin the loan application process. And through there, ordering the appraisal, title and survey, processing underwriting, and then eventually we get to the closing day. And I really want to thank everyone for attending today. We got things done. We were ahead of schedule. We get you out a little bit early. I appreciate your attendance. I appreciate the questions as well. If you got any follow-up questions afterwards, please feel free to reach out so myself and my team can begin to go to work for you and help our next buyer get into a home. So I want to thank everyone. I want everyone to make it a great day. Thank you for taking your time to attend today. Hope you found our information valuable, and look forward to seeing you right here in our next Metroplex Mortgage Services online workshop. Have a great day, and we'll talk to you soon.